Opendoor stock has fallen 95% since 2021, taking the company's market cap to $1.3 billion. And fundamentally, the stock is beginning to look cheap. The enterprise value to revenue ratio is among the lowest multiples in the market. Enterprise value to gross profit is only 1.6, and Opendoor holds a decent amount of assets as well. Net cash is almost half the market cap, and tangible book value is about $900 million. But Opendoor stock is cheap for a reason. The market simply doesn't trust this business model. Opendoor is often referred to as a house flipping business, but in reality it's much more like a market maker. The company provides liquidity in real estate by buying and selling assets when its customers want to transact. This allows customers to transact much more quickly and easily than having to wait for someone on the other side of the trade. And like a market maker, Opendoor aims to generate a spread on transactions, which ends up being about 5 to 7%. However, there are problems with this approach. The first is that many homeowners don't want to sacrifice profits for convenience. Properties hold significant value, and sellers would rather wait for the right price than accept the first offer from Opendoor. Of course, there are exceptions, such as when customers need to move quickly, but they're less common. Another issue with Opendoor's business model is what's known as adverse selection. Assume that Opendoor makes an offer to buy a house that is 5% too low. Almost always the bid will be rejected. But if the offer is 5% too high, it will be accepted, and the converse applies for sales. In other words, Opendoor's valuation errors get filled when the price is unfavourable to Opendoor, but they don't get filled when the price is favourable to Opendoor, and in a huge market like real estate, it's impossible to avoid some errors. This issue of adverse selection is not unknown around Opendoor, and it's been part of the bear case since the company went public via SPAC. But a decade after its founding, the evidence is starting to pile up that the model simply doesn't work. Opendoor did post adjusted EBITDA profitability for the full year of 2021, but it was only $58 million in a housing market that went absolutely haywire. The truth is that Opendoor has failed to produce consistent profits. In 2023, the company lost $627 million with margins of negative 9%. The outlook for this year is for another substantial loss. The company did report over $2 billion of free cash flow in 2023, but that was due to the selling down of property and not a reflection of the underlying business. Opendoor management has talked about higher interest rates and a slow housing market, but that explanation only goes so far. Lower volume for a profitable business doesn't necessarily mean big losses. It should simply mean lower profits. Opendoor has simply never proven that the spread it earns on transactions can cover its costs. The company does have time to work with given the amount of cash on the balance sheet, but it doesn't have forever, and there's simply no evidence that this is a good business. It's for this reason that I give the stock a negative rating, but these are my personal opinions, not financial advice, and I hold no position in Opendoor stock. To see more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.